Real estate is one of the most powerful asset classes to build wealth. The argument is off the table. There is a reason why 90% of millionaires have some sort of real estate in their portfolio, and why some of the wealthiest people on the planet own it. Jeff Bezos, in 2017, had $400 million of a real estate empire. Donald Trump, his corporation has over $2 billion in real estate. Bill Gates has $166 million in real estate. Grant Cardone Capital manages over $4 billion of real estate. Robert Kiyosaki, $100 million net worth, majority of it real estate. There's no shortage of evidence that real estate is a powerful asset. But what if I told you there was an asset that gives real estate investors the ability to purchase more real estate? Real estate now goes from unstoppable to invincible. And some of the wealthiest people have also used this asset class. Ray Kroc created the global expansion of McDonald's. Walt Disney, pioneer of American animation industry. Oprah, iconic African-American woman billionaire. Politicians, holds the secrets of the wealthy. Robert Kiyosaki, real estate icon and author of Rich Dad Poor Dad. So what is this asset class that seems to be a secret that only the wealthy know about? Well, simply, it's life insurance. Now, some of you are screaming at the screen and are about to turn off the video. But wait, just give me one chance to explain. Let me start by asking you a question. What are some of the things you love about real estate? Cash flow, appreciation, tax advantages, leverageable. Well, I'm not here to compare the two because that is actually the complete opposite of what I'm going to do. But just to help you be open-minded, life insurance has the same characteristics. Appreciates, leverageable, has tax advantages, and can be used for cash flow. So now that you know that the wealthy use it and it has some extremely attractive characteristics, let's discuss why you're here, how it can benefit real estate investors. Liquidity. As a real estate investor, you have operating costs, CapEx, down payments, capital to investors, payments to the bank. If you've ever invested in real estate, you understand how important liquidity is. It is the lifeblood of the business, and without it, well, it just dies. Since we all know how important liquidity is, the question is, where do I store my liquidity? The bank, liquid but no growth. The stock market, liquid but risky. So where else? Maybe we go back to where the wealthy store their money, waiting for opportunities like real estate. Life insurance. Safe, liquid, private, leverageable, has tax advantages. You can leave a legacy. Simply, life insurance is the most powerful liquid asset on the planet for real estate investors. Life insurance is the liquidity, not the investment. Because life insurance is leverageable and uses collateral, we no longer have to choose between real estate or somewhere else. We now have an and asset, which means I take $1, I put it in my liquid account, it gets all the benefits of life insurance, and that same exact dollar is used for real estate, the investment. If it was life insurance or real estate, I would say real estate all day long and twice on Sunday if you're a real estate investor. But since we can do both, life insurance is the safe asset to storage your capital, and real estate is the massive wealth builder. You, as the investor, can now go show up more powerfully and get 8 to 25% plus returns in your real estate, while the unsexy life insurance continues to get 4 to 5% growth long term, while it continues to be safe with guarantees built in. It's as simple as that. But I know you still have one other objection, so let me address that. Life insurance. The scam. There are many forms of life insurance, but what we're going to discuss is dividend whole life paying life insurance. Traditional life insurance. When you hear whole life, what do you think? Likely scam. And those who sell it, scum. I get it. I once thought scam too. But as I have matured in life, I've realized we criticize the things that we don't fully understand.
And they are paying you not $3,000 on your $30,000. They are paying you $300 on your $30,000, about 1%, not 10%.
Dave says you get 13% in a mutual fund.
My 4 mutual funds have averaged 13.04%.
So why in the world would you ever put your money into something like life insurance that only gets 1%? On the surface, I agree with that. That'd be silly. But again, what isn't fully understood is criticized. That 13% mutual fund, I will leave that there. I'm sure everybody has their own opinion on that one. But let's discuss the 1% in life insurance. The problem. The traditional way whole life is sold. Traditional whole life's goal is to maximize the death benefit, giving the buyer a large permanent death benefit for their entire life. By maximizing the death benefit, you increase the expenses, thus decreasing the cash value. This is the 1% that Dave Ramsey is referring to. Here are the characteristics: low liquidity, not flexible, slow growth, leverageable, has tax advantages, expensive, high death benefit. Usually these types of policies are good for estate planning. When you want to eliminate a tax issue by putting a policy in a trust, it is a no-brainer for wealthy individuals. In my opinion, outside of estate planning, there are not many other reasons why you would get this type of policy. Definitely not to store your capital. Side note, facts are facts. Traditional whole life is way more favorable from a commissionable standpoint, which is also why you have very little cash value early on. The and asset. The and asset is specifically designed for real estate investors and business owners. It is designed in such a way where we decrease the death benefit drastically to decrease the expenses, which maximizes the cash value. Looking at the two side by side, you can see the drastic difference in cash value. Over $80K difference in the first year. The drastic reason is because of the death benefit. You have $5 million less in death benefit with the $80K more cash value policy. Your dollars can either go to two places when it comes to insurance. One, towards expenses. Two, cash. You choose. Cash value versus a HELOC. Almost every real estate investor that I talk to understands the power of a HELOC or a cash out refinance to buy more real estate. This is why the BRRRR strategy is so prominent in the real estate world. You buy, rehab, rent, refinance, repeat. Smart investors who understand real estate and understand money understand that money sitting in a home does no one any good. Cash flow is the name of the game. So the question I must ask then, why are real estate investors so key on these types of strategies, but are so against borrowing against their whole life insurance policy? My theory comes back to, we criticize a write-off, but we don't fully understand. I get it. There's a lot of noise from the Dave Ramseys of the world screaming scam, or the infinite bankers of the world. When they try to explain the concept, it sounds like they're speaking a different language. But simply put, permanent life insurance with cash value operates very similar to a HELOC. When I say cash value, I want you to replace that in your mind with HELOC, home equity line of credit. Why? Because they both operate in the same way. That's all cash value is. It's a line of credit you can use for investing in more real estate. Here are a few key things to mention with that. In life insurance, the cash value is safe. It isn't exposed to market downturns, and it can't be frozen or taken away from you. In real estate, your home appreciates. Therefore, you can request an increase of a line of credit. But in life insurance, your line of credit increases through compounding interest, and you have a guaranteed rate plus a dividend that you get as a policy owner. You also don't have to request an increase by going through any type of paperwork. It naturally happens every year. And lastly, if it wasn't the cherry on top, it kind of gets swept under the rug, but it's so powerful. The concept has a death benefit attached to it. This is where you have the multi-dimensional asset come into play. You have an asset that's increasing with compounding interest. You can leverage against it to buy more real estate, and now you have protection in place if you die. You could use it to pay off the debts of your properties. You could use it for protection to pay off the debts of your properties for your heirs. The death benefit could be used as collateral to lenders, so they're more likely to give you more funds to go buy more real estate. And this cash value line of credit does not go on your credit report either. So when you go to borrow more money from a lender, it doesn't affect your debt to income ratio, which then allows you to borrow even more money from more lenders. It really is one of the most powerful, safest assets to store your liquid capital, and with all these other benefits, giving your dollars more than one job. No wonder why the likes of people like Robert Kiyosaki endorse such a powerful asset. If you want to see how you as a real estate investor can supercharge this type of policy even more, watch this video as well discussing the Bugatti of life insurance.